Welcome to the 9th session of Thai Institute on managing cash flow for your startup. Today we're going to learn how to budget and manage your cash flow, as well as how to manage debt and protect your reputation. The session is sponsored by Solomon Chartered Accountants. We're thankful for this gesture of theirs. We have very eminent speakers out here today. Let me give you a word about our sponsors. Soberman LLP has been in business for over 50 years and has built a strong reputation in the community because of excellent work its team of dedicated professionals produce. As one of the premier chartered accounting firms in Canada, they are committed to going beyond tax returns and financial statements to provide financial services that generate value beyond the traditional deliverables. Their skilled professionals help small businesses to organize, prepare, and analyze financial information. Soberman LLP is committed to quality in all aspects of their client's relationship. Their reputation for providing quality professional services is vital to their success. They offer a comprehensive range of accounting, tax, and financial consulting service to meet the needs of their clients. They provide innovative solutions and comprehensive range of services that help clients take control of their businesses. A big round of applause for our sponsors. To take us through the first half of the session on this topic, we have with us Ellen Wainer and Ellie Palachi. Ellen is a partner in Soberman LLP, as is Ellie Palachi, with the Assurance and Advisory Group, and he has been with the firm since 1984. Ellen is a member of Management Committee and was partner in charge of the education, more aptly so. Ellen subscribes to Isadore Sharp's business philosophy, and this is a really big one and a good one, which says that profits are regarded not as an end in itself, but as a reward for providing true value to your customers, helping employees grow, and behaving ethically as a corporate citizen. He practices this because both his clients and colleagues describe Alan as trustworthy and dependable. He's always willing to go the extra mile. In 2003, Alan completed the Canadian Association of Family Enterprises Family Council Facilitator Program. He and fellow partner Deborah Stern have also written several articles for publication on succession planning issues. Ellen regularly contributes articles to firms' quarterly newsletters, comments, and to the media. Ellen's passion for education and his heritage has translated into the causes that he is involved in outside of the office. Currently, he sits on the Holocaust Education Week Steering Committee. He's a member of the Leadership Center Advisory Council for the Friends of Simon Wiesenthal Center for Holocaust Studies. Ellen is also a member of Estate Planning Council of Toronto. I do need to introduce Ellie Palachi right now as well, because both Ellen and Ellie Palachi are going to jointly take the first half of the session here. Ellie, again, is also a partner in Assurance Advisory at Solomon LLP. Ellie joined the team in 2004 as a senior manager, and since then he's been instrumental in growth of the firm and its clients. Ellie is genuinely committed to personal and financial success of his clients. He has extensive experience consulting to clients on their internal control systems and has provided recommendations to improve controls and management procedures. He has provided clients with systems audits for controls in place of transaction processing. These assignments include reviewing the processes and procedures established by the management to ensure compliance with predefined and agreed procedures. Ellie also enjoys consulting with clients on general business and tax matters. Ellie has actively involved with the community through a number of associations, including Youth Day Treatment Centers, and Leo Day School. I also do need to add here today that both Ellen and Ellie, they try to make this session very interesting by interacting and involving the participants. Ellen has written a book called Raving Fans. Somebody else has written? Okay, so but he is giving away 2 books to the best questions that are asked from the forum, and the panel that will decide what's the best question will be from Sullivan LLC. And there will also be cue cards given out for a surprise prize out here. Without further ado, I invite Ellen to take this.
Good evening, and thank you, Lily, and the Thai Institute for having us here this evening. I'm sure you've heard the expression that cash is king. Well, this evening, we're going to provide you with some insight as to why this is the case. We're going to mix up the evening with a bit of formal presentation, pose some questions to you, tell you some war stories, but most importantly, have some fun. This includes, as Lalit mentioned, a couple of books for the 2 best questions asked, and a few other surprises. As Lalit said, my name is Alan Wainer, and my partner who's sitting down at the moment is Ellie Palachi. Over the next hour or so, we're going to provide you with some assistance on managing your cash flow for your startup and touch upon it a little bit during the growth stage of your business. We're going to have a short break, I understand, around 7:30, after which Adam Prop of the TD Bank will give you some useful tips. We will conclude with a panel discussion and our closing remarks. I don't know about you, but when I attend an evening seminar, especially after a long day, I get a lot more out of it when there's a 2-way conversation between the presenter and the audience. So let me set the tone for this evening's presentation appropriately by asking you a simple question. When you leave tonight's session, can you tell us, 3 things that you would like to learn, that you would like to get out of this evening's presentation? So I open it up to you. We have someone who will write it down on a flip chart. You came here for a reason tonight. Why did you come here?
Well, if cash is king, I want to know how to manage my cash.
Anyone else?
Where do you get that startup cash from? What's the best way of getting it?
That's why we brought the bank here. We knew you'd ask that question. Anything else?
Remember, there's a price to this question today.
Yeah.
Efficient management of cash.
Okay. Anyone else, or we'll continue? So, I'm sorry.
Softwares you can implement for managing cash flow.
We can try that. Okay. So as we go through the session tonight, obviously what we'd like to do is look back at your responses to ensure that we do cover them in some fashion. So I'd like to start with a little story about a current situation to give you a little bit about insight into cash flows, preparation and projections. I have a client who obviously will keep names and details anonymous and a little bit from the reality, but to give you at least some idea of what you got to think about. He is constructing a building. The purpose of the building is to do repairs for industrial type of equipment. And let's say the building costs about $5 million. He's got about $3.5 million of his own money, and he's looking for another $1.5 million. He does have some real estate that he's looking potentially to sell. And he came to us about 45 days ago and said, can you help me get bridge financing until I get this property sold? I trust you're familiar with the term bridge financing. If you'd like, I can clarify what that is.
Please.
Okay, sure. Think of it this way. You own a house today that you sold and it's going to close in June for some reason, but you bought a second home that's going to close in March, and you need that 3-month period to have the cash flow that's going to come in on the sale to cover you from March to June when you move into the new house. Well, that's what's called bridge financing. So my client, in a similar situation, has real estate he wants to sell, but he has a certain payment plan dealing with the construction of this building that he has to meet, and he only came to us, unfortunately, 45 days before he's going to start running out of cash. So we're trying to help him get some bridge financing. And because of the nature of the situation, there are certain things that banks can or can't do, so they've provided us some sources that they know, and we have 2 or 3 possibilities in terms of getting that financing. So the key lesson is, because he only came to us 45 days before he needs the money, is that he planned to have enough cash when you need it. And that's the key takeaway from that story, and I'll continue part of it as we go through some of what I'm going to cover. A startup business often begins with ideas and a lot of enthusiasm. One of the many issues that every entrepreneur must deal with in starting a small business is the financial reality involved in deciding exactly what he or she wants to do, when it can be done, and how it's going to get done. In other words, what are their plans? We all know that the best way to formalize them is in the form of a business plan. Just to refresh your memory, in case you're not familiar with it, or, as I said, haven't addressed it recently, the components of a business plan include your cover page, your table of contents, your executive summary, the business background, that is the entity, the product or service description, the business facility assessment or location, marketing plan, action plan covering operational and management issues, financial elements, and possibly an appendix with supporting documents. Although your product and location of your business are key elements to any business plan, the projected cash flow budgets are vital. In a startup situation, you're going to have to rely on 2 things. You're going to have to rely on your financial projections, meaning they will be based on assumptions that you've made as to how your business will perform in the future. And secondly, you're going to have to rely on your ability to sell yourself as a potentially successful business owner or entrepreneur. Which takes me back to the story I started a few moments ago. My client, once the building is up, then has to get an operating line for the business. He's got to put together 2 things. One is cash flow projections are going to be needed for that operating line. And although he has a lot of experience, he's got to make sure that A, these cash flow projections are realistic, and they're most likely going to be based on contracts that he hopes to sign with prospective customers. And, of course, his experience in the business, which he's done something similar before. So with that in mind, let's start with the 5 aspects of managing cash flow for your startup. I will cover the financial goals and working capital areas, what I'd like to think is that, unfortunately, the dry area of the presentation, and developing budgets. Ellie will cover monitoring budgets and managing your cash flow, the more interesting part. And Adam will cover fostering positive financial reputation and implementing procedures to manage debt. Don't be surprised if Ellie or Adam put in their 2 cents during my part of the presentation, or me in their part. It's just our way of keeping each of us on our toes, and we expect you to do the same. Any questions at this point? So, let's start with slide number 1. Why are financial goals important? 3 things, there's probably more, but we have a limited time tonight. Financial goals provide focus and direction. Think of it as you have a ship, and if you don't know what direction you're heading in, you're going to just go in circles. So that's one of the reasons why you need financial goals. It helps you set targets and also, of course, realize your potential, your full potential. You know, in everything you do in your life, it's always better to set goals, targets. It gives you something to shoot for, and it makes heading in that direction that you do decide to go in much easier. I'm sure you've heard of this acronym before. Set SMART goals. Goals need to be specific, they need to be measurable, they need to be attainable, they need to be relevant and time specific. I will touch upon a couple of them in a little more detail. Let's talk about attainable. When you're developing a business plan and your projections, you have to make sure that the goals are realistic. One of the ways to do that is, if you have somebody you're working with in developing your business plan, make sure that you write down your goals, you discuss it with that person, and get some feedback. You don't want to make the goals too easy to reach, and you also don't want to make them too far-fetched. And that will come out as you do your business plan, and you will see in developing your cash flows how realistic they are or not. But again, it's always good to stretch the goals a little bit more than you think you can get to push yourself a little bit harder. Time specific. Again, you can develop short-term goals, long-term goals. Short-term could be 3 months, 6 months, a year. But once you go past a year, because we live in a very volatile world economy, you're going to have to use, as we'll discuss a little bit further on, assumptions that may not be realistic. So the further out you go, the chances are that the projections, as you get closer to that time period, will have to be readjusted. Working capital. In simplistic form, working capital is cash on hand when you start your business, cash coming in minus cash to be paid out. That's your working capital. However, what that really means on the cash coming in, it's basically taking, if you're selling a product, just as an example, turning that inventory into receivables and then into cash. The cash going out is, what are you paying to your suppliers for your product? Taxes, whether they be income taxes, commodity taxes, payroll taxes. You can go on, there's too many taxes, I know, that we have to pay out, and what's left, it's another story for another time. Paying off debt. Debt could be to a bank, short-term or long-term, the current portion of that, which is payments that are due in the next 12 months. Plus, and maybe even debt that's you loan to your startup that you want to start paying off to yourself because you're starting to build up some cash flow. The importance of working capital is very simple. It provides a snapshot of your financial position for the short term. It indicates your ability to meet your obligations as they come due. There are generally in each industry different types of standards, and banks, when they look at lending you money, there's generally going to be a ratio that you may have to meet for working capital. If your working capital is greater than 1-to-1, you know you're going to be in the black, or you're going to have positive working capital. If it's the other way, you're going to be in the red. Obviously, we'd prefer the former than the latter. So let's move on to the managing part of the working capital. Understand its meaning, and that is it needs to be positive. That's something people think, well, it's simple, but it's not that easy to attain. And that means keeping your financial records up to date. That means you know what's going on. Matching credit and payment terms. To expand on that, think of it this way. You buy product and your supplier wants you to pay it off in 30 days, but your customers only pay you in 60 days. So there's going to be a gap, and that gap could be permanent unless you can move the dates and make them closer. If you can get your customers to pay you off a little bit earlier, let your suppliers get paid a little later, that will help in the cash flow. Keeping business separate from personal expenses. Again, you're not going to really know how well your business is doing if you're putting through personal expenses. And we'll talk a little bit about personal expenses in a startup because it does have some bearing. And using all the tools available to you, credit cards, debit cards. Again, be careful with credit cards because the interest rates, as you know, are high. If you don't pay it off in the due date, you'll be charged interest. Any questions at this point?
You
Yes, sir.
mentioned about paying off the debt to yourself, in case if you have put in some money for startup.
Correct.
What's the best way of paying yourself back? Just take check to yourself, or is there a procedure for that?
There's no real procedure, it's just how much cash is available, that's needed to run the business. And, if the business grows and you had some personal buildup of capital to get you started, you can put it in if it's an incorporated company, and I believe you had a seminar on different structures previously, that if it can go in the way by way of loan or by issuance of capital, stock, and as the company starts building up equity, there'll hopefully be some extra cash, or you've got the equity, so maybe you can use your line of credit to pay you off personally. So it depends on the circumstances. It's very simple. Is there enough cash to continue if you pulled out that money? And there may be times where you pull out the money, but there's times in the year that because of seasonality, you may have to put it back. And you have to decide whether you want to do that or not.
Okay.
Anything? Yes, sir.
So will you be discussing the gaps between payments and expected?
Yes. But just to answer your question in short order, one of the keys is to have enough startup capital cash when you start your business. Otherwise, you're asking for a lot of trouble because before you know it, you're chasing your tail to find that money to fill the void. And instead of focusing on other aspects of the business, you're always focusing on I'm short of cash, I'm short of cash. I ran into a situation in the service business that the entrepreneur relied on someone who felt spend, which is good to a certain extent, but got them into a hole that we had to help them out. The person who was working with the entrepreneur is no longer there. We brought in someone else and slowly brought them on stride because they had too much debt for the type of business they were in. And all they had spent their time on is cash flow management as opposed to focusing on their service. So they spent many hours each day on that. But we'll touch further in it shortly. So what is a budget? It's an organizational plan stated in monetary terms, revenue and expenses. That's one way to look at it. It's a tool to project future cash flows. Somebody asked about software. One of the ones that I use on a personal level, I've used it for years, is Quicken. Quicken. And there's QuickBooks, which is for businesses. And a lot of small businesses do use that software. The reason I use Quicken, not just because I'm an accountant, but because it's a really useful tool to manage my cash flow. It has a budget feature by month. So if I want to develop a budget and then as I enter in and download my receipts and disbursements, I can compare. I can at least see, okay, am I spending more? Am I spending than budget or less, and why? And so I could respond much quicker than just trying to figure it out in my head. At least I got it right there on the computer. And I've used it for at least 10 or 15 years. And I found it very, very useful, and it's helped me. And I've used it because of my experience on a personal level. It makes it easier to convey how to help my clients, whether it's on the Quicken, which is the personal side, or QuickBooks, which is for the business side of it. It is a tool, as I said, to project future cash flows. It could be short-term or long-term, and as I mentioned before, short-term is really a year, maybe two. I helped the client develop a 5-year budget, but again, the assumptions may not be realistic after year 2 because things change very quickly. And another way of looking at it, it's a financial communication device. Preparing a cash flow budget, 4 easy steps. Prepare a sales forecast, that's your starting point. Project your inflows, sales, collections, receivables, loan proceeds, etc. Project your outflows, again, cost of goods sold, if you have product, inventory, payroll, rent, and all other operating expenses, accounting fees, loan payments, interest, one-time purchases, etc. And then you come up with your cash flow bottom line. The next slide, from my perspective, is a very important one, and that is developing a budget. The first thing is your assumptions in your control sheet. What that means is, I'm sure you're all conversant with Excel spreadsheets. That sheet is your sheet where you put in all your assumptions and all your variables. So for example, if you're doing a 1-year budget and you're saying your starting point is, for argument's sake, 100,000 of sales, on your control sheet, and let's say you think sales are going to go up 2% a month, for argument's sake, that control sheet would be there to allow the sales on the actual spreadsheet to go up 2% a month. If you change it to 3 or 4%, so this way, once you've established that first sheet with all the assumptions, then you can play with different scenarios, and the output comes out very easily. And you can keep changing it until you feel comfortable with it. Consistency with business plans and goals. I mentioned seasonality before. Here's a very simple and perfect example. You have a seasonal business, and let's say 75% of your sales will occur between January and June, and 25% in the last 6 months. So if that's what you say as you're going through the verbiage of your business plan, your cash flow projections better be somewhat similar. Otherwise, a banker looking at it will say, well, hold on a sec. On one hand, you say it's 75-25, but what you're showing is sales are evenly across the year. And so it's very important, and that's the role we play when we help clients with business plans. The key area we get involved with, of course, is the cash flow projections. But we review it from a macro perspective, not just the details, and say, okay, is there consistencies in everything that's been in there, or are there inconsistencies? Look at past performance or current market conditions. Obviously, if it's a startup, there isn't any past performance, but there could be. What you have, which we didn't have years ago, is access to an internet. And there's so much information there on relative in terms for specific industries that may help you in developing your business plan or your cash flow projection. Current market conditions, of course, will have a bearing on your cash flow projection and your budget. Identify one-time versus recurring expenses. Obviously, when you start up a business, there's going to be a first-time expenses. Think of it, if you bought your first house, there's many things that you didn't have that when you were renting an apartment, like a lawnmower, for example. A barbecue. So it's the same thing in a business. You're going to have one-time expenses, and you may have one-time expenses during the course of the life of the business, but obviously in the startup, as we're discussing tonight, there will be a number of expenses. The last item is really for accountants, not entrepreneurs. Be conservative and plan for emergencies and contingencies. It never hurts to put in some type of contingency in terms of expenditures when you're developing your cash flow projection. As a small case in point, when I'm involved with condominium corps or co-ops, and the property management companies put together their budget, there is always contingencies for the repairs of the building, because they don't know, even though they may have a reserve fund study that's done by engineers and what the projected expenditures are going to be. Yes?
What percentage of your budget should you allow for contingencies?
It could be as percentages, whether it could be anywhere from 2 to 5%. I mean, and that's just general guidelines. But you may just look at it and say, okay, my expenses are 500,000, do I put 25 grand? Do I put 50 grand?
The other thing you can do is just do a sensitivity, so increase all your expenses by 10%. See how that has an effect on your monthly cash flow. You know, just go worst case, best case.
Yes?
I'm just curious, when we develop a budget and we'll continuously modify it, when should we begin to modify it, daily, weekly, or monthly?
Well, once you come up with what is going to be part of your business plan, and the one thing you should never lose sight of is if you find someone you're going to deal with at a bank that you like, they will help you. They're not going to just look at it and say, well, we don't like it, and here's our reasons why. They'll, they have their own evaluation system, but they'll help you in saying, here's what you need to put in there within the terms of the parameters, and they will help you make those assessments. So obviously that are realistic as possible, because they've probably have experience with other businesses in the area that you may be starting up one. So let's say you've established your business plan as it is, and you've gotten some bank financing, including your projection. You may modify it every month or every quarter. It depends on how things start off. If you get the sales that you're projecting in the first quarter, you may not have to. So, as I mentioned just very shortly, in our office, we see what the cash comes in every day, just to give us an idea of what's coming and what's going in. And a lot of businesses, they go online, they see what's come in, because a lot of clients may pay by electronic funds transfer, but they also want to see what the balance is. So, in the old days, you used to wait till you got a bank statement, like 10 days after a month, from what I recall. But you can obviously, you know what's in your bank account. And, if you have amounts owing to your suppliers, and you need 50,000 and you have 45, you have to decide, you're going to have to make a conscious decision on who you may have to hold off paying. So these are just guidelines, and obviously depends also on the person's personality. Some people need to check it every day. Some people can go with a week without checking it, depending on how their business operates and when payments are due. Have I answered your question? Yes, sir.
When you're planning for cash outflows, how do you plan for the taxes that have to be paid?
Well, it depends which taxes you're talking about. Payroll taxes generally are due by the 15th of the following month. Commodity taxes could be quarterly, monthly, depending on the size of the business.
Mainly on the profits.
For the income tax, the general, if you have a December year end, generally, and it's your first year, the balance of taxes would be due 3 months after the end of the year for a small business. But in your second year, you're going to have to already start making monthly installments based on the prior year. So what happens is you may not know your actual figures after your first year till the end of February, for argument's sake. So you then would know, okay, I owe taxes for the prior year at the end of March, and I have to start making monthly installments, and if you have the cash flow, you would then true up these first 2 months of payments at the end of February. So for example, if you owe 12 grand after you determine what your profits are before tax at the end of December, you owe 12 grand at the end of March of next year. But then you'd have to make $1,000 a month starting in 2012. If you know the number by the end of February and you have the cash flow, you issue a check for $2,000 to true you up, to catch up. There may be a little bit of interest, and there's ways around it, but that's the basic rules in terms of small business from an income tax perspective. But that all being said, in your first year of business, if you're incorporated, you may decide to take an additional salary to wipe out the profits and break even, because you may need the money to live on anyhow. And then you wouldn't owe any taxes for purposes of corporate tax, but you may owe payroll for your salary, and depending on when you actually pay it. You can set up what we would call an accrual, payable to yourself, to wipe out the profit, break even, and let's say you make the payment of the salary in March, you probably owe the payroll taxes in April. Does that help you?
Yeah, perfect, thank you.
You're welcome. So I'm just going to end with something I think you may find useful. It comes out of a small business financing book. I mentioned there's initial setup costs. There's a page showing you generally some of the things that you're going to face. And if you wish, we actually have a handout of these schedules. So that's part A. Part B is personal living expenses. And the reason you take that into account for a startup is if, let's say, you're starting a business and your spouse has a job and is doing quite well, you'll know that if, are you going to be in the black on a personal level, or are you going to have a shortfall as well there, and you have to take that into account. Hopefully you're in the black and not in the red. And so this is just gives you an idea of some of the things. Again, if you had Quicken, you'd have this all on a budget, from a personal level. And this continues going through the various expenditures, life insurance, rent, telephone bill, vacations, hopefully. So that's Schedule B. Schedule C is your business operating costs for the first 90 days. And a lot of these have similar titles as they do for the on the personal side. So when you get to the end of it, you got the recap. You got your initial setup costs, Schedule A. Your operating dollars needed for the first 90 days, Schedule C, and add the two together. And then personal cash needed or available. Hopefully it's available. And then the cash needed for personal business survival, as we would call it during startup, in the first 90 days. This is a very useful tool to help see what you're going to have or need to start off. Someone said, how do you close the gap? Well, if you've got a certain amount of money to start up and incorporate it into your cash flow projection, 100,000 to start up, 50,000 to start up, and then you start dealing with the cash coming in, the cash going out, you'll know how big, if there's still a gap. And when you're developing a budget, and you do, as I mentioned with the assumptions, here's an example. If you have sales in month 1 of 100, how much gets paid in month 1, how much gets paid in month 2, and how much gets paid in month 3? Is it 25-50-25? Is it 50-50? Depending on your business. That's some of the research you're going to have to do as you develop the projection. That's where an accountant can help you, a banker can help you, the internet, and various associations. So before I pass the baton on to Ellie, do you have any further questions?
I have one small one.
Sorry?
A small
Sure,
small
go
one. Okay, where does the role of a new entrepreneur ends and where the role of a CPA or an accountant starts? Like, where do I outsource? Like, what do I outsource? Like the whole.
That really depends on your background and whether you're going into business yourself or not. Some people will start using an accountant from day one. Some have a good accounting background and feel they can do it on their own and do it on their own. Small case in point, I have a relative who is a website designer, and he started in the business out of school, worked for a small organization 5 to 7 years, and then started on his own. And of course, because he's very conversant with software packages, put everything together. The only time he got me involved was to do his corporate tax return and a little planning. So it really depends on someone's, first of all, background, and second, their ability to pay and who they're going to go to, because there is a cost, right, to use a professional. And there are, through the banks, through Googling the internet, you can find places that can help you out. We have helped startup businesses, or we refer them to, Adam, you will find out very shortly, does work with financing for startup, so he's a great resource. So those are a number of areas, and each one has to be looked at on its own. Any other questions?
Just as
An add-on?
add-on, so are you through the association offering a special for startup companies?
What we would do is I would sit, and Ellie would sit with you for an hour and consult, and then we'd see where we head. What you would know in advance is approximately what it would cost and see, in terms of affordability, and if it's not us, we would find you somebody. But that's how we generally work, and sometimes what we have in certain situations, depending on the circumstances, but sometimes we'll have is, we'll sit down with somebody for an hour or so and help them out and find out, based on affordability, they can't come to us, but we always treat people right and with respect. As mentioned in my little bio, I just like treating people, we like treating people the same way, we'd like to be treated. And so they come back to us maybe 2 years later when things start growing and realize, now they can afford to use a bit larger firm, and they have more needs, and they have the ability to pay. Does that help everybody? I now pass the baton on to Ellie. Thank you.